So we can start.
Hi, very good afternoon to all of you. I hope in this challenging period you are all safe and sound and you are doing well in this challenging time. If we come to slide number 3, we have repeated this many times. It's a perfect storm: medical crisis, financial crisis, and economic crisis all coming together to ravage global economy as well as local economy. Slide number 5 shows in a very apt manner what is the current situation of businesses. They are slow moving like a snail, but they are sitting on the edge. They cannot remain here for long. And whether they move forwards or backwards, there is bruise and there is cut. Slide number 6 talks about all the fiscal and monetary stimulus given by various governments around the world. The world has never seen this kind of stimulus. This resulted into extremely low level of interest rates as depicted in next slide. Almost 60% of debt instruments around the world are yielding less than 1%, and 86% of debt instruments around the world are yielding 2%. That's the kind of drop we have seen on interest rates across the world. This extremely high liquidity and extremely low interest rate, next slide number 8 shows, has helped in recovering losses on the bond side as well as on the equity side. Global bonds and global equity both recovered their losses in index terms. However, slide number 9 shows you what is the actual scenario. Yes, bonds and indices in equity have bounced back, but there is extreme polarization. In Standard & Poor's, now there are Standard & Poor's 5 stocks, which is Facebook, Amazon, Apple, Microsoft, and Google. They are up 35% year to date. The remaining S&P 495 is minus 5%, and which is where S&P looks like trading almost at the same level as +2. There is rich S&P 5 and poor S&P 495. If we look at the economic data in US, bankruptcies are almost touching 2008 level. Business consumer confidence is collapsing almost to 2008 level. And this is despite US government and US Fed taking all these steps to support economy. There is US presidential election coming in the month of November 2020. No president has won election when economy is in turmoil, and undoubtedly President Donald Trump will do everything possible under the sun to ensure that economy revives. The miracle economy is actually China, which created this Wuhan virus, and there the activity levels are anywhere between 80 to 100% of pre-COVID level. The exports reflected in container freight, the traffic congestion at the port, the power consumption, the real estate floor sales, all are pointing towards normalization. Why is China able to do this miracle? Well, next slide, slide number 12, shows the miracle of China. It's printing credit at an unprecedented level. While their debt is almost $30 trillion to the non-financial side, the GDP is roughly about $15 trillion. They have added more debt than GDP since 2008 crisis. Coming to Indian economy, slide number 14 suggests that from the bottom of April lockdown, economy has recovered. In the April lockdown, the business resumption index calculated by Nomura was averaging 45%. It went up to 70% in the last week of June, but throughout the month of July, it's stagnating at 70. It's not going back to pre-COVID level of 100. Clearly, Indian economy is trying to revive, but it's facing certain headwinds. Slide number 15, slide number 15 suggests the sectors which will be impacted aggressively by COVID-19. Overall, people are expecting GDP growth to decline anywhere between -5 to -10% for FY 2021. Slide number 16 shows the fault lines of Indian economy. The household savings rate has declined from the heights of 2012 at more than 25% to about 20% in FY 18. The corporate balance sheet is over leveraged, and the central and state government borrowing program this year is likely to exceed almost 16 trillion rupee. All this is resulting into a scenario where consumers are saving less, corporates are over leveraged, and government is over borrowing. If we go to next slide, slide number 17, it shows drop in capacity utilization for various companies, and clearly this drop in capacity utilization is impacting investment decisions. When your capacity utilization is lower, undoubtedly you are not going to invest into new capacities. If we go to slide number 18, it shows deterioration in the corporate quality. In FY 2010, 90% of companies were earning more than their cost of debt. In FY 20, it is forecasted that just about 30% of companies in India will earn more than their cost of capital. Between FY 10 to FY 20, in 10 years, companies' ability to earn more than the cost of debt is compromised, and that's going to have impact onto the growth side. If we go to slide number 19, it shows the challenge which we are facing as mutual fund as well as debt market investor. The number of companies whose credit rating has fallen into issuer not cooperating category is now almost 50% across many rating agencies. Obviously, we have to focus on large rating agencies like CRISIL, ICRA, CARE, which are very critical. And there also you see that in March 20, half the companies are unable to give data in terms of sustaining their rating. A company will resort to this kind of measure only when they are not looking towards future with hope. Slide number 20 suggests potential GDP recovery. We believe there will be businesses which will be impacted far more, and there will be businesses which will be impacted far less. If you have to buy a motor car, an air conditioner, a travel expenditure for holiday, you are going to defer it as much as possible, and which is where the red line suggests that discretionary consumption related sectors like hotel, tourism, travel, aviation, automobile, it could be down 60%, and it may take next year for recovery. If you go to industrial goods and services, which is dark yellow line, it will fall little less than discretionary consumption, but in absence of higher capacity utilization, new investments will take time, and it will take probably next year before it can recover. The Yellow line suggests non-discretionary consumer goods and critical infrastructure. This will be more related to necessary spending on pharmaceuticals, on some of the soaps, detergent, shampoo kind of item. There the drop will be minimum. People will not defer buying shampoo or detergent. They may downtrade, but certainly they'll go and defer travel expenditure. The least impacted will be essential and acyclical sectors like food and necessary items related to day-to-day living. There, the impact will be bare minimum. This kind of recovery will be prolonged, U-shaped, and different across different sectors. Next slide shows an interesting chakra view faced by India's entrepreneur between finance, taxation, commercial, general, industry, secretarial, labor. There are thousands of X which one has to face, and those number of X puts thousands of compliance burden onto the entrepreneur. If we can really improve ease of doing business on ground, things can be totally different and growth can recover substantially. The bright spot among dark clouds, the silver lining among dark clouds is rural India. Slide number 22 shows how rural India is supporting recovery this time. PM Kisan Disbursement Fund, the daily average tractor registration in July is almost 40% higher than June and significantly higher than May. Fertilizer volume growth at producer level in June was 10%, in July was 23%. Pradhan Mantri Kisan Samman Yojana has been front-loaded, and compared to last year, it is up 15% year on year. Manrega allocation has jumped from 60,000 crore to 1 lakh crore, and that's putting money in rural economy. The biggest driver for rural economy, as reflected on slide number 24, is monsoon. In the month of June, monsoon was 20% above average. In the month of July, monsoon was little bit deficient. And today, monsoon is at 0%, is at long-term average. This has resulted into Kharif season sowing area growing at almost 12% over last year's level. A good monsoon in the month of August could help revive rural economy. The reservoir water level across the country is 70% higher than last year, and that bodes well for rural economy in Rabi season as well. Slide number 25 shows the problem faced by urban India. Fortunately, there are mixed signals. The power consumption, which was growing at 7% above year-on-year level in the month of March, has now come back to almost par. It's at the last year's level, and this is a significant jump, almost 30% recovery from the level seen in the month of April. E-way bill generation in July 20 is now 89% of previous month. The car registration has also jumped in the month of July, where Maruti's sales number were 1% higher than last year, but overall registrations are 69% of last year. Effectively, urban India is trying to stabilize, and slide number 26 gives you data across many high-frequency indicators compared to last year. Slide number 26 shows retail e-transactions, e-way bills, custom duties, TV advertisements, diesel petrol consumption, electricity, rail freight, and so on and so forth. Everything is pointing towards recovery in the month of June and July, but in the second half of July, things seems to be stagnating. They are not able to go up to the previous year level, and barring few situations like bank credit or TV advertisement, the previous year's levels are not breached. If you look at company, they are taking this crisis as an opportunity and cutting cost. Companies are becoming effective in terms of working capital management, and across various sectors, we have seen working capital cycle improving for corporate India. Finally, if we have to summarize entire economic activity, GST transactions provide us great opportunity. In the month of June, GST number was 91,000 crore. That was significantly lower than last June's number of more than 100,000 crore. However, in the month of July, at 87,000 crore collection, the numbers have come reasonably in comparison to the number in July. Slide number 29 suggests how India is taking vis-a-vis others in terms of policy changes. And this is a comparison done across various people's feedback. In India's case, 35% believes that we have wrong track, but 65% believes that we are in right direction. This is reasonably well above global comparison, where 42% of the people believe that their government is taking right decision, whereas 58% believe that we are in wrong direction. By and large, Indian economy, we can safely say, is better positioned vis-a-vis rest of the world. However, this crisis has its own challenges in urban India. Rural India may post positive GDP growth in FY21, but urban India will drag down FY21 GDP growth between -5 to -10%. Coming to slide number 31 on the market, undoubtedly, companies have been damaged significantly by coronavirus crisis, and the impact on companies is far more than 2008 global financial crisis. Slide number 32 suggests what was the potential movement of equity indices, Nifty 100 over 12-month period after every crisis. 2016 demonetization was just about 10% drop in Nifty 100. And in 1 year period, it went up by more than 15%. 2019, COVID-19, the correction was about 35%. And thereafter it has recovered, and now it is about 10% lower than all-time high level. Obviously, within Nifty, Bank Nifty has fallen far more. It was down 60% from top, and it has recovered just about 50% from bottom to be somewhere near 30% lower than its all-time high level. 2008 global crisis correction was almost similar to Nifty Bank, and it took about a year to go back 10% over its all-time high level. Clearly, COVID-19 is going to cast doubt on many companies, and one will have to be careful in selecting companies to make money in this market. Slide number 33 suggests drop in earning estimate of Nifty. When we started 2020, the expectation of Nifty was 769 rupee. As we ended the year, the number came down to 454 rupee. 2021 estimate is now 462 rupees, just little above than FY20 earnings of 454. Our fear is that as we move ahead, these numbers could further drop. FY22, people are expecting earnings to be somewhere around 600. And this is a big number which a good medical solution and fiscal and monetary situation can probably achieve. If we go to slide number 34, we have tried to put together all the possible factors which will influence market. The markets will be moving like pendulum based on what kind of valuation level we reach, what happens on US China, and we expect it to deteriorate further. What is US presidential election results? What are the trends in consumption? What is the trade and supply chain behavior? How does medical solution emerge on COVID-19? What kind of oil shock happens, and any other black swan event? In terms of policy responses, fiscal and monetary situation will be supportive, but how effective are measures to contain virus will also have its response on market. Markets obviously will be driven by liquidity and sentiment and what happens in credit markets. Put together, all these factors will keep market on a pendulum basis. It will swing between optimism to fear, between pessimism to greed. Slide number 35 suggests what is market discounting at this point of time. It's discounting current account surplus India after a gap of almost 2 decades, courtesy lower gold imports, which were down 90% in first quarter, courtesy lower oil prices, and courtesy reduction in trade deficit with China. Market is also assuming rebound in economic activities, courtesy fiscal and monetary package given for MSMEs, for NBFCs, for agriculture sector, and foreign direct investment flowing. Market is also expecting more FPI flows to come in the days to come. And most importantly, market is discounting a medical solution round the corner. If actual scenario is better than this, markets will continue to rise. If actual scenario is worse than this, markets will fall. On the medical side, slide number 36 shows how top 12 contenders of vaccines are in various trials of development. 2 vaccines in China, Sinovac and CanSino, is in phase 3 trial. Moderna and University of Oxford's trial has already reached phase 3. In Australia, they are using BCG vaccine in phase 3 trial. In India, Zydus Cadila and Bharat Bio is already into phase 2 trial. And Novavax, which is developing a vaccine in US, is also about to begin its phase 3 trial. Post phase 3 trial, one gets the approval, and there are rumors or news reports emanating from Russia that they have already discovered vaccine for coronavirus. However, one obviously needs to see data before taking any view on the same. The trade deficit with China on slide number 37 suggests reductions from about $63 billion in 2018 to $49 billion in 2020. There is a reduction of almost $14 billion. However, we need to lower it further, somewhere around $30 billion this year. There has been severe drop in imports as activities has come to standstill in the month of April and May, and India registered one of the steepest decline in non-commodity imports, courtesy that strict lockdown. Slide number 39 shows that investors have appetite for good quality companies issuance. Reliance has raised more than 1.5 lakh crore, including their latest investments from Google. Companies like Kotak Mahindra Bank, Axis Bank, ICICI Bank has been able to raise capital in tens of thousands of crore. It clearly shows that investors have money for good quality companies. Slide number 40 shows FPI behavior. They have been buyer in the month of May, June, and July on equity side, and marginal seller on the debt side. Unfortunately, the mutual funds have to put redemption due to redemptions have sold equities in the month of June, in the month of July, and probably July equity sales data on mutual fund side will be negative to the extent of 3,000 to 5,000 crore. Slide number 41 suggests the potential FPI flows which could come courtesy MSCI and FTSE rejig. FTSE rejig is applicable over September quarter, December quarter, March quarter, and June quarter. The MSCI rejig was expected to be announced on 30th June, but now they have deferred pending certain data clarification. If we put all this into market point of view, certainly July 20 is looking far better than December 2007 or May 2013. There are challenges, but it's not that it's insurmountable. Slide number 44 suggests that this time rally has been sharply polarized, and it's driven mostly by technology, pharma, and FMCG kind of sectors. If we look at bottom part of the chart, calendar year 2020 performance, small cap is down 14% year to date, mid cap is down 10%, and Nifty is down 9%. Within that, healthcare has been best performer, up 39%. Technology, another best performer at 15%, and FMCG has closed positive. The drop has been led by banking PSU at 44%, and private sector banks at 33%, and real estate almost comparable at 33%. Clearly, this was the year where long healthcare, long technology, long FMCG delivered better return compared to any other indices. Slide number 45 shows the performance across market capitalization. On 31st of Jan, Nifty mid-cap was delivering better return than large cap. Nifty small cap was still positive across most of the spectrum. But when you look at the data on 31st July, Nifty mid-cap and Nifty small cap have delivered fairly lower return over 5-year, 10-year period. Slide number 46 shows polarization in market. Like S&P 5 and S&P 495 are totally different. The same thing has happened in Nifty 50. When you look at Nifty on 31st July, it's trading at 11,073. But Nifty 15 stocks led by Reliance are trading at 14,950 level. And Nifty 35 is trading at 8,411 level. Clearly, 15 stocks are showing the rise in the index, and other 35 stocks are showing the pain of coronavirus. Slide number 41 suggests our call on the equity throughout the month of March, April, May, June. We were overweight equity, but from now onwards, we are giving a call to be neutral weight equities, looking at the sharp run up in equity and valuation and the potential crisis ahead. So we are changing our stance from overweight equity to neutral weight equity from the month of August onwards. Slide number 48 suggests Nifty is now trading at 2018 level, Nifty mid cap at 2016 level, and Nifty small cap at 2014 level. The market cap to GDP ratio, after dropping significantly in the month of March to 56%, is now nearing its long-term average of 75%. This is time to be neutral weight equity at market cap to GDP ratio, which is hovering around historical average. Market on slide number 50 shows that on a price to book basis is just little below fair value. And despite that, we are taking a call that this is time to be neutral weight equity. What value add our partners can do to their clientele? Well, slide number 52 suggests how this is possible. When we tell people that you should be overweight equity when markets are cheap, you should be underweight equity when markets are expensive, they have invariably come back and said, Nilesh bhai, why don't you do it? And this is what we have been doing in our Kotak Balance Advantage Fund. With the benefit of hindsight, on 17 January 2020, when Nifty was 12,352, market valuation was above its historical average. It was beginning to look expensive, and our equity allocation fell to 39%. Our balance advantage for NAV and that day was 11.36. And as we came into 20 to 40% category on pure equity allocation, the call was given to be underweight equity. On 24th March 2020, against everyone's expectations, market corrected to 7,800 Nifty. Our valuation model was considering it cheap, and we went to 75% equity allocation against maximum possible 80%. Obviously, due to sharp correction in market, our NAV came down to 8.52, but this was the time to be overweight equity allocation as our pure equity allocation moved into 60 to 80%. Today, at 11,073 Nifty, we think market is fairly valued. Our pure equity allocation has become 50%, and our NAV is at all-time high level of 11.39, and we recommend people to become neutral weight. You can get Kotak Balance Advantage Fund net equity allocation on a daily basis on our website. And I will appreciate if you can share a video which I have prepared on how partners can choose Kotak Balance Advantage Fund equity allocation to arrive equity allocation for their clientele. Slide number 51 gives our daily pure equity and total equity allocation, which you can take then advantage in order to create overweight, underweight, and neutral weight for your clientele. Slide number 54 suggests how we worked during credit crisis of the month of April. We were doing conference calls with distributors, with clients, and coming on media to tell investors not to redeem in good quality credit risk fund. Many people followed WhatsApp messages and social media. They didn't listen to our partners. And in the month of April, people who redeemed, they ended up pushing us to sell our papers at a higher yield, as everyone in the world knew that we were sellers of credit papers. This resulted into credit spread widening, and credit risk fund delivered -32 to -42% annualized negative return. As our efforts paid off, our partners' efforts paid off, credit risk fund redemptions came down. We were no longer desperate seller. And in the month of May, June, July, credit risk funds have delivered on an annualized basis 20 to 23% return. People who followed WhatsApp media and social media gurus ended up losing 20% annualized return making opportunity in the month of May, June, July. If they had listened to you and stayed invested, they would have made 20% annualized more return on their credit risk fund. Slide number 55 suggests SIP returns. Again, there is a lot of pressure on SIP on direct platforms. People who don't have access to their distributors to handhold during this crisis period, they are shutting down their SIP when it is the best time to do SIP. If you look at Kotak Emerging Equity Fund return on a 5-year basis, in the month of Jan 2020, the returns were in double digit at 11%. In the month of March, it became -4.54%. And in the month of July, it has become +4.24%. Yes, on a 5-year basis, 4% SIP return is not appropriate. It is lower than fixed income, but it has turned from -4.5 to +4.24. It's a jump of 8% return on a 5-year basis between just March to July. In a bear market, SIP return always looks bad, but if you continue doing your SIP in the bull market, same returns deliver fantastic return. On a 1-year basis, this SIP was yielding -41% on March 20. Today, the same SIP is yielding 6% positive return. What happened in Kotak Emerging Equity also happened across all other funds like Kotak Equity Opportunities. like Kotak Tech Saver Fund, as illustrated in next two slides. Slide number 58 suggests how it is important to continue your SIP, especially when markets are down. This illustration of continuing your SIP throughout the downturn of 2008 shows what kind of value addition is possible from minus 32% return to plus 8% return. Slide number 60 shows about Kotak Balance Advantage Fund. This fund has completed 2 years last month. It's a fund which has delivered fantastic return as we had promised during our launch time. We said this fund will try to deliver equity kind of return with equity fund minus volatility. On a 1 year basis, it has delivered 8.7% positive return when markets are down by about 10%. And on a 2 year basis, it has delivered about 6.6% return. The upside ratio of this fund is 68%, whereas the downside ratio is roughly about 44%. This is based on Morningstar methodology, and the capture ratio of upside divided by downside is 1.55, one of the highest in the industry. Kotak Balance Advantage Fund is one of the best performing balance advantage fund in terms of its category. And this has been done with one of the lowest volatility, one of the lowest capture ratio, one of the highest capture ratio. Kotak Balance Advantage Fund should be part of every client's portfolio if they want to participate in this fantastic journey. More importantly, this Kotak Balance Advantage Fund pure equity allocation will also guide you towards what kind of equity allocation can be done in client's portfolio. Slide number 61 talks about the asset allocator fund, where we divide between debt and equity. Against last 1, 3, 5 year, our asset allocator fund has delivered positive return, significantly outperforming Nifty as well as hybrid debt fund. While the corpus of this fund is small, but any investor who is wanting fund manager to do the asset allocation should be looking to invest in Kotak Asset Allocator Fund. Over last 5 years, it has outperformed Nifty by almost 3 percentage points after paying for expenses. Next slide talks about Kotak Equity Opportunity Fund, where we believe this is time to move from large cap funds, where industry has more than 200,000 crore part, into large and mid cap funds, where return ratio could be attractive. Slide number 63 talks about hybrid funds like Kotak Debt Hybrid Fund. This fund also has delivered positive return over 3, 5, 7 and 10 year basis. Almost 75% plus portfolio is allocated to fixed income that keeps volatility low, and equity exposure at 25% delivers capital appreciation when equity markets enter bull territory. The old monthly income plan, now rechristened as Kotak Debt Hybrid Fund, is also appropriate for conservative investors. Most of you will remember that we gave a gold call for investment in the first week of March. At that point of time, gold price were trading at about $1,450, $1,500. We send this by way of WhatsApp messages, by way of emails, and that call has worked out very well. We were basing our call on gold based on 2008 pattern, where first gold price is corrected from $1,000 to $750 and then went all the way up to $1,900. The same pattern got repeated in 2020, where gold had corrected from $1,700 to $1,450, where we gave a buy call, and today it's trading upwards of $2,000. This has been a sharp journey, and a lot of investors have captured it in gold ETFs or sovereign gold bonds. Our outlook going forward on gold remains positive. Of course, it's a commodity, so it will go up and down. But if you are taking 3 to 5 year view, gold appears better placed than fixed income. Slide number 66 suggests that generally post 2008 crisis, central bankers have become overweight gold. And if the same pattern is repeated in 2020, the central bank buying will support gold prices. Slide number 67 suggests that gold ETFs have received lots of money across the world. And today, gold ETF inflows are higher than equity ETF flows. Slide number 68 suggests that if looking at the performance, looking at the lower interest rates, looking at the higher liquidity, if various institutional investors decides to invest in gold, the amount of buying in gold which can happen is more than $2 trillion, and it is multiple times 2008 gold actual demand. These are all pointing towards positive price on the gold side. Generally, gold prices go up when real interest rates are lower or negative, and that is illustrated on slide number 69. Slide number 70 is capturing our calls which we gave during this monthly presentation. In the first week of March, we had given buy call on gold. In the first week of April, we gave overweight on equities in a staggered manner. In the first week of April, we had also talked about Kotak Equity Arbitrage Fund to remain invested in that despite other people giving redemption call. And in the first week of May 2020 and last week of April, we had told people to remain invested in Kotak Credit Risk Fund and Kotak Medium Term Plan and ignore WhatsApp voices. We are happy to announce that in less than 6 months period after giving this call, all of these calls have worked out quite well. Gold is up at lifetime high level. Equities have bounced back more than 40% from bottom. Arbitrage funds in the month of March, volatility has delivered one of the best return, and Kotak Credit Risk and Medium Term Fund have delivered positive return of more than 20% plus on an annualized basis between May, June, and July. Coming to the fixed income side, clearly fixed income market has witnessed huge liquidity. More than 650,000 crore is lying in the interbank system. However, this liquidity is not reaching out to the borrowers. We have seen one of the lowest credit growth over decades and one of the highest spread on the yield curve reflected into slide number 73. The green line suggests 10-year low credit growth, and the yellow bar suggests 10-year high spread on the 30-year minus 1-year government security. Slide number 74 suggests space available to RBI for cutting interest rates. In this credit policy, they didn't cut policy rates, but there is enough room for RBI to cut interest rates in the days to come. Right now, probably they deferred rate cut as inflation numbers were averaging more than 6%. And the core inflation number is averaging about 5% as reflected in slide number 75. Slide number 76 shows that because of this kind of mixed signal, how interest rates have remained range bound in the month of July. Slide number 77 suggests how yield curve has become steeper. Short-term rates have fallen more, long-term rates haven't fallen as much. Between February 2020 and July 20, 3-month rates are down 177 basis points. 1-year rate is down almost similar at 170 basis points, but 10-year rates are down just 53 basis points, and 15-year rates are down just 48 basis points. This drop in yields at the shorter end is reflected into corporate bond. Slide number 78 shows the corporate bond spend of a AAA rated bond and AA minus rated bonds. Today, AAA rated bonds are trading between 33 to 55 basis point over GSEC, a significant drop witnessed in the month of March at almost 300 to 200 basis point. And the same trend is reflected into AA minus bond. Slide number 79 captures stimulus given by credit policy day before yesterday. Our outlook on the debt is reflected into slide number 80, where we believe interest rates will remain range bound with a downward bias. It will swing between 5.5% to 6% for the time being, and eventually it will start swinging between 5 to 5.5% over a period of time. Slide number 81 shows what we believe in managing our fixed income. Return of capital is more important than return on capital. Slide number 82 suggests how our portfolio is divided. 97% of our AUM is in non-credit risk fund or low credit risk fund, and 3% of our AUM is in credit risk fund. Across our debt portfolio of more than 97,000 crore, 94% is in T-bill, GSEC, government securities, AAA, A1 plus rated bonds, or cash and non-current assets. Only about 2% portfolio is below AA minus level, including AA minus allocation. Out of 97,000 crore portfolio, just about 2% portfolio of about 1,800 crore rupee is rated below AA minus, including rating of AA minus. Slide number 83 suggests liquidity profile of our fund. This data is available on our website, and you could see that apart from our normal funds, even credit risk fund and medium-term fund has one of the highest liquidity in the industry. Slide number 84 suggests our experience that even when credit event occurs, it's not full write down. You can always recover the money at a later date by working with promoters, by enforcing your security in case promoter is playing hanky-panky. We did this in the month of April 2019 when we had to stop redemption. We had to withhold redemption in 6 of our FMPs courtesy SL Group exposure. And we are happy to announce that in 6 months time frame, by September 2019, we could recover all the money and pay back to our clients with interest. Slide number 86 suggests what opportunities are available in debt investment at this point of time. For conservative debt investor, banking and PSU debt fund, Kotak low duration fund will be more appropriate. For people who can afford to take credit risk and will not be upset by credit event, Kotak credit risk fund or Kotak medium term duration will be appropriate. Slide number 87 suggests why Kotak low duration has shifted in terms of its asset allocation from having 25% of portfolio in AA minus and below. Today, we have just about 7.5% portfolio in AA minus and below. Next slide suggests journey of Kotak credit risk fund and Kotak medium term plan. This funds today at current level of yield provide an attractive opportunity to invest, and investors who will invest in this elevated credit spreads should make more money in the days to come. Slide number 89 suggests how credit profile has moved. We had always promised you that we would like to sell lower rated papers to meet redemptions so that residual investors don't end up suffering. And we have actually done that across April, May, June, July portfolios. More importantly, within those portfolios, we have migrated our papers to higher quality papers. Slide number 90 suggests how Dynamic Bond Fund has been able to deliver value to its investors. And over last almost 3 years, the fund has delivered 9.25% return. Slide number 92 suggests an investor awareness program which we are carrying out with InvestMentor. This booklet is available in e-version, and many IFAs are creating a personalized copy of this by co-branding. InvestMentor has received recognition where even people from regulatory bodies are calling for an e-copy of the same. And after going through, they are saying that this is one of the best booklet published on educating investors. Today, more than 2,500 InvestMentor books have been co-branded with various distributors and forwarded to their consumption for onward submission to their client. In case you would like to co-brand InvestMentor, you can go onto the Kotak MF Advisor link and complete the formality to do co-branding of this InvestMentor book. I'm sure all your client will appreciate this value add. Slide number 93 suggests our video coaching Pro Start, where our trainer Tejas Thakur has been conducting various programs for educating our partners. Slide number 94 has details about other videos which are being prepared and circulated. And in this coronavirus time where it's difficult to move out, I will recommend each one of you to enroll in ProStart and get the necessary training which will help us scale your business. Slide number 96 suggests about our SIP POS facility. Many investors are using SIP POS as they believe over next 2, 3, 4 months, they will be able to resume their SIP. Slide number 97 suggests about our Kotak Business Hub. Sorry, this is same SIP POS and cancellation facility through our website. Next slide talks about Business Hub, which is a value-added portal for our partners, and it allows you to initiate transactions for existing as well as new investors. And it also allows you to circulate emails for your customers based on their behavior, based on their transactions. We'll recommend all of you to take advantage of Business Hub. You can install various mutual funds whom you sell in their app, on their app and on their website, and they will be able to get all the data necessary for doing cross-selling and upselling in their portfolio. Slide number 99 suggests our Kotak Mutual Fund YouTube channel, where we keep on publishing various videos between myself, Harsha, Lakshmi, Harish, Pankaj, and give you ideas about market, economy, and fixed income. As I mentioned, this year we have been particularly lucky to give great buy calls on gold, on equity, on remaining invested in credit risk fund. And today we are giving neutral weight to equity despite the current volatility, current situation. Do subscribe to our YouTube channel and watch our videos so that you are well informed to tackle your customer queries. With this, I have come to end of my presentation. We will be now stopping live relay on YouTube, and we will continue to remain on Zoom call to answer queries raised by our distributors. You can put